Joe Balestrino is a fixed income market strategist at Federated Investors. The firm manages more than $392 billion in assets. And Joe, always good to see you. Thanks for joining us.
Thank you, Betty.
You know, watching actually in the last few weeks, the yields have actually gone up in bonds. I mean, has the bond market pretty much done the work for the Fed or what?
Really think they have done the work. We've seen rates go up on the 10-year about 40 basis points in just over 2 weeks. So this sounds to us like, buy the rumor, sell the news kind of thing. We believe the Fed today would like to just go through year-end in an uneventful, no liquidity concerns fashion and regroup in January.
Right. All the excitement is going to be when the new year starts then, Joe. But for today, though, the statement, what are the key phrases that you're going to be looking? I mean, I highlighted some of the key phrases, but what are you going to be looking for in that statement?
You did, and I think the key phrases that you highlighted will remain exactly unchanged. We will look for what we anticipate seeing is a clear, explicit expression that things are, in fact, getting better. The jobs market in particular is much better. It looks like the retail sales environment, the manufacturing environment, while we're all at weak absolute levels, the trend is undeniably toward the positive, and we think the Fed acknowledges that. Having said that, they will they will err on the side of deflation, and that's why the language will remain the same.
Right. Okay. Well, then, given that, then for the bond markets next year, let's say, starting in January again when things get moving, you still see more room then for the yields to go up?
We do, and I would say quite a bit more room. We've turned the corner. This business cycle will no longer visit negative GDP numbers. Earnings will be very strong year over year. Obviously, the year over year hurdle is pretty small at this point, but nonetheless, corporations have a lot of liquidity. The economy's starting to grow again. Yield should go well into the fours out the curve, and we think it steepens, and then you have a big flattener later in the year as the Fed actually starts to raise rates.
Okay, so Joe, in the time that we have, how do you position yourself then right now?
Yeah, the easy trade in our minds is literally to reduce interest rate sensitivity, shorten maturities, increase what I will call economic sensitivity in fixed income. Corporate bonds have come a long way, but they're still historically cheap and they're making money, and you might as well collect that excess spread. We still think there's some capital appreciation in front of us, especially in the high yield market. So go down the quality spectrum and go down the maturity spectrum.
Okay, easy money. We like that, right? Okay, Joe, thank you so much. Joe Balestrino at Federated Investors.